Welcome to UXL, where you can learn new skills anytime and anywhere. Visit uxl.com to explore our full course selection. This lesson is part of a larger course. Check the video description below for a link to the full course where you can enroll. If you enjoy our content, please like and subscribe. For your convenience, the course cover displayed on your screen provides the complete course title and lesson title. Let's proceed with the lesson. Lesson: Market Equilibrium and Price Determination. Market equilibrium and price determination are fundamental concepts in the study of economics, particularly within the framework of supply and demand. These concepts explain how prices are set in a market economy and how different forces interact to balance the quantity of goods and services supplied with the quantity demanded. Understanding these mechanisms is crucial for comprehending how markets function and for making informed decisions in both business and policy contexts. At the core of market equilibrium is the interaction between supply and demand. The law of demand states that, all else being equal, as the price of a good decreases, the quantity demanded increases, and conversely, as the price increases, the quantity demanded decreases. This inverse relationship is represented by the downward-sloping demand curve. On the supply side, the law of supply states that all else being equal, as the price of a good increases, the quantity supplied also increases, and as the price decreases, the quantity supplied decreases. This direct relationship is depicted by the upward-sloping supply curve. Market equilibrium occurs at the point where the quantity demanded equals the quantity supplied. At this equilibrium price, there is no excess supply or excess demand, and the market clears. If the market price is above the equilibrium price, a surplus occurs because the quantity supplied exceeds the quantity demanded. Producers will then lower prices to clear the surplus, moving the market back toward equilibrium. Conversely, if the market price is below the equilibrium price, a shortage occurs because the quantity demanded exceeds the quantity supplied. This shortage prompts producers to raise prices, again pushing the market toward equilibrium. To illustrate these concepts, consider the market for wheat. Suppose the equilibrium price of wheat is $5 per bushel, where the quantity demanded and supplied are both 1,000 bushels. If the price rises to $6 per bushel, the quantity supplied might increase to 1,200 bushels, while the quantity demanded might fall to 800 bushels, resulting in a surplus of 400 bushels. Producers, unable to sell all their wheat at this higher price, will reduce prices to clear the surplus, driving the price back toward $5 per bushel. Conversely, if the price falls to $4 per bushel, the quantity demanded might increase to 1,200 bushels, and the quantity supplied might decrease to 800 bushels, creating a shortage of 400 bushels. In response, producers will raise prices to eliminate the shortage, again moving the market toward equilibrium. Several factors can shift the supply and demand curves, thereby changing the equilibrium price and quantity. For demand, these factors include changes in consumer preferences, income levels, the prices of related goods, expectations about future prices, and the number of buyers. For example, if a new health study reveals that eating wheat has significant health benefits, consumer preferences for wheat may increase, shifting the demand curve to the right. This shift would result in a higher equilibrium price and quantity, assuming the supply curve remains unchanged. On the supply side, factors such as changes in production technology, input prices, expectations about future prices, the number of sellers, and natural conditions can shift the supply curve. For instance, if a technological advancement reduces the cost of producing wheat, the supply curve will shift to the right, leading to a lower equilibrium price and a higher equilibrium quantity, assuming the demand curve remains unchanged. Government interventions, such as price controls, taxes, and subsidies, can also affect market equilibrium. Price ceilings, such as rent controls, set a maximum price that can be charged for a good, often leading to shortages as the quantity demanded exceeds the quantity supplied at the controlled price. For example, if the government sets a price ceiling of $4 per bushel on wheat, the quantity demanded might increase to 1,200 bushels, while the quantity supplied might decrease to 800 bushels, resulting in a shortage of 400 bushels. Price floors, such as minimum wage laws, set a minimum price that must be paid for a good or service, often leading to surpluses as the quantity supplied exceeds the quantity demanded at the controlled price. Taxes and subsidies also influence market equilibrium. A tax on a good increases the cost of production, shifting the supply curve to the left, which raises the equilibrium price and lowers the equilibrium quantity. For example, if the government imposes a $1 per bushel tax on wheat, the supply curve will shift to the left, resulting in a higher equilibrium price and a lower equilibrium quantity. Conversely, a subsidy lowers the cost of production, shifting the supply curve to the right, which lowers the equilibrium price and raises the equilibrium quantity. If the government provides a $1 per bushel subsidy for wheat, the supply curve will shift to the right, resulting in a lower equilibrium price and a higher equilibrium quantity. Market equilibrium and price determination are dynamic processes that continuously adjust to changes in supply and demand conditions. For instance, the oil market is highly sensitive to geopolitical events, technological advancements, and changes in regulatory policies. In 2020, the COVID-19 pandemic led to a significant decrease in global oil demand as travel restrictions and lockdowns were implemented worldwide. This demand shock led to a sharp decline in oil prices, forcing producers to cut back on supply to restore market equilibrium. Similarly, advancements in renewable energy technology are gradually shifting the demand curve for fossil fuels to the left, influencing long-term price trends and market dynamics. In labor markets, supply and demand determine wage levels and employment rates. The demand for labor is derived from the demand for goods and services that labor helps produce, while the supply of labor is influenced by factors such as population growth, education levels, and workforce participation rates. For example, the rise of the technology sector has increased the demand for skilled labor in fields such as software engineering and data science, leading to higher wages and greater employment opportunities in these areas. Conversely, industries facing declining demand, such as traditional manufacturing, may experience lower wages and reduced employment. Understanding market equilibrium and price determination is essential for policymakers aiming to address economic issues such as inflation, unemployment, and income inequality. For instance, central banks use monetary policy to influence interest rates and control inflation by affecting aggregate demand. By raising interest rates, central banks can reduce borrowing and spending, shifting the aggregate demand curve to the left and lowering the equilibrium price level. Conversely, by lowering interest rates, central banks can stimulate borrowing and spending, shifting the aggregate demand curve to the right and raising the equilibrium price level. Similarly, fiscal policy, involving government spending and taxation, can influence aggregate demand and thus affect market equilibrium. During economic recessions, governments may increase spending and cut taxes to boost demand, shifting the aggregate demand curve to the right and raising the equilibrium output level. Conversely, during periods of economic overheating, governments may reduce spending and increase taxes to cool demand, shifting the aggregate demand curve to the left and lowering the equilibrium output level. In conclusion, market equilibrium and price determination are central concepts in the study of economics, providing a framework for understanding how prices are set and how markets function. The interaction between supply and demand determines the equilibrium price and quantity, with various factors influencing shifts in the supply and demand curves. Government interventions, such as price controls, taxes, and subsidies, can also impact market equilibrium. By analyzing these mechanisms, we gain valuable insights into the functioning of markets and the effects of economic policies, enabling us to make informed decisions in both business and policy contexts. This concludes the lesson. We trust you found this video informative and engaging. To enroll in the complete course, please use the link provided in the description below. At UExcel, we are committed to your learning journey. Each course offers a certificate of completion, online support, and downloadable resource files to enhance your experience. If you found our content valuable, we invite you to like this video and subscribe to our channel. Thank you for joining us. and we look forward to supporting your continued pursuit of knowledge.